Welcome to the RevOps Lab, a podcast exploring the art and science of revenue operations. To find more episodes and resources on scaling your revenue engine, visit getReFlow.com/RevOps. Before we dive into today's episode, here's a quick insight. We asked the community how they capture activities in Salesforce. The result? Almost 2/3 of you use Einstein Activity Capture or Salesforce for Gmail and Outlook. And while it's great that you care about activity capture, those solutions can be quite problematic. For example, running reports and analyzing your activity data is often a nightmare with Einstein Activity Capture. And those who use Salesforce for Outlook or Gmail often miss activities because logging them is manual and time-consuming for your reps. That's why we built ReUpload, a Salesforce activity capture solution. Hundreds of revenue teams use ReUpload to auto-capture emails, meetings, and contacts. ReUpload then permanently stores your activities in Salesforce so you can run activity reports, build automations, and get better insights. You can even sync past activities for up to 24 months. And with our admin console, you have full control over your setup. The best thing about ReUpload? You're up and running in less than 30 minutes. So visit getreflow.com/activity to learn more and get your free trial today. Thanks, and we hope you enjoy this episode.
In this episode, we are talking to Ben Murray, or better known as the SaaS CFO. We'll go deep on all things finance metrics, how a P&L of a SaaS company looks like, and SaaS metrics. It's our belief that finance and RevOps should closely work together, especially on the FP&A and RevOps side. And I hope you enjoy this show. Thank you so much. All right, welcome to another episode of the RevOps Lab. I'm here with Ben Murray, or also known as the SaaS CFO. Ben, welcome.
Thanks, Jan. It's great to be here.
Yeah, I'm actually especially excited about this one. I was on your podcast back when we raised from Gradient, and I've been following your work for quite a while. But before I go into that, who are you? What do you do?
Sure. I'm a CFO by trade, so I got started in the airline industry in finance and accounting, then transitioned over to software in the early 2000s and came up through the ranks of financial planning analysis, so forecasting, metrics, budgeting, and then became CFO at founder and private equity-backed SaaS businesses. And then about 4 or 5 years ago, started my own business offering fractional CFO work, coaching, have an academy, teach SaaS metrics and finance. And really it all started with my blog at the SaaSCFO.com.
How big is the blog? How big is the newsletter by now?
Yeah, so the newsletter, I just sent a newsletter this morning and it's about 75,000 subscribers.
Okay, so learning number one, if you want to learn more about the topics we're going to talk about, subscribe to that newsletter. Also, I highly recommend to go to your website. What's the exact website? It's
So it's, THE, SaaSCFO.com. Yeah, so that's my blog and where you can, download my templates as well.
Yeah, it's a great website if you want to understand all things finance and SaaS metrics. And there's a lot of good templates. There's tons of video tutorials. And together with the newsletter, I think it's really like an academy. So I want to plug this strongly because I've spent some time on there and there's great sheets you can download. And so if you want to learn about, finance and SaaS metrics, please go there. And this is exactly what we want to talk today about, right? So I think there's this constant debate in RevOps around should you report into the CRO, the CFO, how do you work with FP&A, especially on the annual planning side, which I think we're now hitting the cycles for most companies. And today what we want to do is basically walk through the finance metrics, the SaaS metrics, and then go into a bunch of different questions around how finance and RevOps work together. So let's start with the finance metrics. Let's start really simple. What are bookings?
Okay, so so bookings, we talk about in SaaS bookings all the time. So a bookings in my definition is an executed contract between us, our company, and our client, our customer, for our products and our services. So really it's just a contract saying they're going to purchase, say, our SaaS subscription, any services, hardware, it depends on our revenue streams. And, that's about it. So legal agreement, but if you're, and I teach this in my course, if you're like, hey, Ben, I don't speak the bookings language, I don't have a CRM, Same thing if you're self-service or PLG, we still have to derive that bookings data because we need to know where our growth is coming from. And again, a booking is not an invoice, it's not revenue, it's not cash, it's simply a signed contract or purchase order.
Yeah. So it's basically what most sellers are very happy about, right? When they basically send the DocuSign, refresh every 10 seconds to get it signed. And then, like what are some of so how do you move from bookings to actual revenue, right?
Yeah, so that's really interesting. And of course, I have a post on that at my blog. But you think about kind of that SaaS CFO utopia of quote cash. So, right, we send that quote out, we send the contract, the customer signs it. And of course, sales is like, yeah, great, perfect, done. But then you ship that contract over to accounting. So now we get that MSA, the sales order, purchase order, whatever it is. And now, right, we have to process that. We have to set up the subscription. We have to invoice the customer correctly based on the payment terms, the products that they signed up for in the contract. So we invoice that customer, and that could be, right, a monthly invoice. It could be an annual invoice. It could be professional services revenue. And then once we go to close the books, right, that's an invoice. And assuming we're not charging via credit card, it's not cash, it's not revenue yet. It's simply an invoice out to our customer. And then when your controller CFO closes the books each month, then maybe we have to apply some revenue recognition. If it's an annual invoice, 12-month term, now we have to spread that out over the 12 months. And that's part of that financial close process, or you hear about closing the books. And then we record that revenue appropriately in that month. And then, of course, then we've got to collect the cash. So it's kind of that, that quote to cash cycle, starting from sales and then finishing with accounting.
Yeah, that sounds pretty simple, but obviously there's different stakeholders being involved, right? So you get that, a purchase order, you take it, you send the invoice. Let's say there's a 12-month deal, right? Like you basically, how do you then split it across the months and do the revenue recognition?
So with RevRec, there are different frameworks. A very common one is daily RevRec. So it's based on the days in the month. So if we have a 12-month subscription, it's going to be based, prorated based on the days in the month. So February, not as many days, the revenue will go down a little bit, that MRR number. Or sometimes you can just take that annual value. Let's just say it's $12,000 annual invoice, divide by 12, and just post $1,000 a month. Kind of depends on your subscription start and end dates and your RevRec policies. But basically, we're amortizing or spreading that revenue over from that subscription start date to the subscription end date.
So it sounds to me like, if you basically sign a deal on the 10th of February and you basically take the full February, that's accounting wise not 100% correct. Is that right? Or?
Yeah, it just depends. I think people do it different ways, where, maybe if it's in the first half of the month, they take the full RevRec. If it's the back half of the month, maybe half of it, kind of almost gets to like fixed assets and CapEx. But usually on daily RevRec is usually, it depends on when you start the subscription. If it's like, hey, they're starting September 21st, all right, well, then we have to do some proration. And usually it's based on the number of days.
Yeah. Okay. So this is essentially a pitfall and something you have to decide on and basically have clear rules so your accounting system works. Okay, what's a MRR schedule? You talk about this a lot on your blog. Maybe not everybody's familiar with it. Yeah, what is it?
Yeah, so I say, your MRR schedule is worth its weight in gold, because it's going to come up with potential investors' due diligence. So really an MRR schedule is really just revenue by customer by month. And generally for your recurring revenue, and I just got this question from a student, what about professional services revenue? No, that's usually excluded. So any one-time revenue is excluded from your MRR schedule. So again, it's revenue by customer by month is the start. Then we could do that by ICP, by pricing plan, SMB versus enterprise. And then what we do, we take that and we create what I call the MRR waterfall. So we take that data and then we have an MRR beginning balance. We have new MRR coming in, expansion, contraction, churn, and that creates our ending balance. And then from that MRR waterfall, that's where we then create or calculate gross revenue retention and net revenue retention.
Okay, let's go through this one more time because, we're on a podcast. Not everybody's going to watch the video. And actually, there's nothing,
nothing
and it's presenting right now. So you have starting period MRR, and then what's the waterfall again?
Yeah, so again, that MRR waterfall, you start the month out. we have a beginning balance of MRR, monthly recurring revenue, and then say we signed a new customer, and then let's say that starts on the first of the month. And so we're going to either maybe that's a monthly invoice or we're doing RevRec on that. So we have new MRR coming in, and then we have our existing customer base. So any expansion revenue. So say you upsell or cross-sell that customer last month, and now they're paying more in this month, we'll see a number in that expansion layer. And vice versa, say they contracted. Say like, hey, I don't need as many seats. Now they're paying less in the month. Then that's a negative number in the contraction bucket. And then we have churn, right? Customers who just completely lost us. So again, it's beginning balance plus new MRR, expansion, contraction, churn, and that equals then our ending balance of MRR for the month.
And renewals, do you put them in there as well? Or?
So renewals, right? Renewals will only show up in that waterfall. Of course, it's in the beginning balance, but only if there's a net change, that it would show up either in the expansion bucket or the contraction bucket. Otherwise, it's just in that beginning balance and ends up in the ending balance as well.
Yeah. Okay, understood. So this is basically the MRR waterfall, right? Okay. So based on the schedule, it's actually really, really important. And I think one thing, I like about this is, right, like when you think about forecasting, right, you usually not only want to forecast your new local business, you also want to forecast your expansion and renewal business, right? And this is, I think, something we, as a forecasting tool, deeply advertise for, like, being able to look at the entire revenue input factors that then basically flow into this specific schedule, whether you do that on the ARR side or the MRR side, right? But yeah, that's really important. Sorry, yeah, please.
Oh, I was going to say, yeah, you're right. It's so important for revenue forecasting. You can't just take, hey, I'm running at 100K MRR and add a growth percentage to that. To be really accurate with SaaS revenue forecasting, you need that MRR waterfall and then by segments. Because if you have an SMB and enterprise product, those retention profiles are going to be much different. So one, it makes your revenue forecasting much more accurate. And of course, we're coming up to planning our budget season for next fiscal year. And then we need that data, the MRR waterfall, to calculate those retention metrics, which then feed other metrics. So it's just so important, the FP&A process, and for any SaaS CFO out there and for founders as well to understand their waterfalls and retention schedules.
So I think this is super interesting what you're saying, because most SaaS companies forecast their pipelines on bookings, right? That's the typical way on, and that can be broken down into ARR often, if you have a mid-market or enterprise deals. So you basically have the pipeline, you forecast new logo expansion, renewals, right? And this is to a certain extent happening more on the RevOps side. And then you have essentially the finance side looking at those schedules, right? And looking at the historical data and trying to make sense of, okay, what could the future look like? And I think this is one of the challenges. How do you bring that together? Any tips there?
Yeah, definitely. I think, on the RevOps side, yeah, definitely, right? As we're thinking about planning or just forecasting in general or forecasting 2025, what's that high level number? What's that commit number we're going after for next year, for that next quarter? And as a CFO, I'm expecting my CRO, my VP of sales, marketing, RevOps team to be doing those calculations on their lead pipeline, on their opportunity pipeline, so they can then tell me what's that weighted average ARR commit number that they're after. Because I see a lot of people who want to, on the finance side, model that out, but I'm expecting that to come from the RevOps function, because then I can take those bookings numbers by product line, by ICP, whatever those segments are, and feed that into my forecast model. So of course, I work with a lot of early stage companies where maybe they don't have that sophisticated pipeline set up yet, or really not effectively using their CRM. And then really it's all right, tell me your new customer growth, where you think that's going. Then I can look at expansion, contraction, churn, and those historical patterns to make some assumption to put together a revenue forecast. So, really, it's kind of that, with me, the 80-20 rule of forecasting is RevOps. I expect them, give me that commit number. Of course, and this might be a question coming up, but, I need to also understand their pipeline, their lead flow, how that works, what's important, what are those conversion points, just so I feel good with understanding that process, so when I get that data, I understand it better.
Yeah, I mean, it's I think it's always in context of size and maturity of the organization, right? It's always in context of how many you go-to-market motions do you have, how many geos, segments you're targeting, right? It can become very complicated to create a bottom-up annual plan, and then, I mean, we could probably have, completely separate show on that. I want to dive further into the SaaS P&L. Like, what's a typical SaaS P&L? How does it look like? What are the line items?
Yeah, so the SaaS P&L, of course, there are a lot of versions out there, but I'd say what I've worked on and just my experience in SaaS, this is how I set it up. And usually, it works for boards, investors, potential investors, private equity. So if we think about the revenue section on our SaaS P&L, we want it by clear and distinct revenue categories. We don't want to commingle revenue streams. So we need to see subscriptions, so true subscriptions, so fixed MRR or AR contracts, no variable revenue in there. And now, of course, we've got usage revenue, processing, consumption, transaction. I kind of lump that all together as variable revenue. We've got to keep that separate from our subscription revenue. And then next, professional services. If we have the setup, configuration, onboarding of our customers, training, we need that in another bucket. And then also I work with customers who have a hardware play as well. So software plus hardware. And then we've got a hardware line. And then last but not least, maybe managed services. So I'm also seeing a lot of managed services where it's what I call like people-powered subscription services revenue. So our product is not delivering that revenue stream. It's still people behind the scenes, but on a subscription basis. So then we could have managed services, and then another bucket that may catch conferences, adjustments, miscellaneous stuff. So that's the revenue section. Then we have COGS, or cost of goods sold, or cost of revenue. And for pure play SaaS, we have tech support, professional services, if applicable, DevOps, so your hosting, your architecture, security, and then customer success if they don't sell. And then we could have a variable expense bucket too. For example, if we charge for every Twilio message that goes through, there's a hard expense for that. So I'm going to bucket that in a variable cost center in the COGS section. So I know I'm covering a lot, but we can circle back here. And then OpEx, below gross profit, it's always R&D, sales, marketing, and G&A, and that's just the way it is. So that's the SaaS P&L setup.
Okay, so revenue, different line items. Not all revenue equals recurring revenue, right? You basically have the different line items. Then you have COGS. Customer success, is that typically in COGS? Is it not? What's your view on it?
Yeah, highly debated topic. Always get a lot of comments on LinkedIn or in my course when I teach that. And so my kind of test is it's they're focused on product adoption, the customer journey. They may get a bonus on some sort of retention figure, but they don't have a quota or get paid commission. Then I'm going to put them in COGS. But if they have, say if they're performing an account management role or account a role and they have quota commission, then I'm going to put that down in sales. In early stage SaaS, sometimes they're doing both. And then we allocate between COGS and sales.
If you enjoyed this episode, feel free to check out the RevOps Letter, a newsletter where Yannis and I share insights from the best revenue operators in the world. It's packed with actionable tips, insightful reports, and strategic advice. And if you have questions, just hit reply and we'll answer them personally. That's what over 1,000 operators love about it already. Go to getreflow.com/RevOps Letter or just go to the show notes and subscribe now.
Got it. Yeah, I mean, that makes a lot of sense to me. And it's obviously a very important topic, as a lot of the compounding growth over time comes from existing customer, the bigger you get. But yeah. And then on the kind of epic side, right, like sales and marketing costs, right? Like what's typically flowing into that? Because that is actually a pretty important number, I'd say, for all things SaaS metrics. Yeah, how do you what are some examples, line items that sit in the sales and marketing expenses?
Yeah, so if we think about our SaaS P&L and below gross profit, we have the marketing cost center department. So of course, we're going to have people costs, wages, taxes, benefits. And then, of course, very common to have a lot of contractors in certain departments as we scale. So contractors as well. And then, of course, marketing is one of those where we have a lot of discretionary spend. So non-people spend, so conferences, trade shows, paid ads, SEO, blog posts, So we want that detail sitting in marketing so we can understand maybe cost per channel, cost per lead, things like that. So that's where marketing usually is, kind of sometimes, I don't know, it varies. Maybe it's half wages and half discretionary spend, or even more on the discretionary spend side. So that's where we lead a lot of detail in the forecasting process and budgeting process.
Yeah. I mean, on the sales side, it's probably the opposite, right? It's very much people driven, or
yeah. So it's really people driven. So wages, taxes, benefits, of course, commissions, travel if we're traveling, our CRM software, and maybe some training, but really heavy people expenses.
Yeah. And I think we've all been there, right? Like planning out kind of the sales capacities and, how do you scale and what are the ramp times, right? So we could probably spend another, 30, 40, 50 minutes talking just about that. We will skip that for now, right? Let's assume, we're all set. We have a fantastic P&L. Everything is attributed perfectly, right? Canva, right? That's also a lot of work which goes into that. But so you have all the metrics, right? Like, let's switch gears to SaaS metrics. Like, what are like the SaaS metrics you look at to measure SaaS businesses?
Yeah, so I have this 5-pillar SaaS metrics framework. So in SaaS, of course, we love the acronyms. We have tons of metrics, but I've tried to organize that, and also helps us to measure the right SaaS metrics for the right stage of our business. So the first pillar is growth. So it's really focused on bookings. So new bookings, expansion bookings, where is our ARPA going? So average revenue per account. And then maybe contracted or committed ARR is also a number we could be looking at. So that's the first pillar, is just really good data on bookings and where that's coming from, that growth. Then pillar 2, right? We're landing customers, we're expanding customers. Now we're retaining them. So pillar 2 is all about retention. So customer retention, gross revenue retention, net revenue retention, and then potentially some sort of CSAT or NPS measure to support the retention story. And then also, if you're an annual contract or multi-year contract setting, renewal rate. Renewal rate is very important in that. And then pillar 3, you're going to throw a lot of things at you, but we can link some show notes to this. But pillar 3 is margins. As we scale, gross profit is so important. We know best-in-class gross profit for pure play SaaS is 80%, and we want to scale to that eventually. And then also, if we have multiple revenue streams, we need to know margins by revenue stream. How much is subscription contributing, variable revenue, services, hardware, for example. And then pillar 4 is our financial profile. So EBITDA, Rule of 40, ubiquitous SaaS metric, our OpEx profile. For example, how much are we spending in R&D as a percent of revenue? That's going to scale over time in a certain direction. And then finally, efficiency. So pillar 5, so go-to-market efficiency. So CAC payback, LTV to CAC, cost of ARR, maybe magic number. And then also really important, if you're trying to get, that path to profitability, is org efficiency. So rev per FT, and then I created a metric called ROSE metric, which is recurring revenue generated for every dollar of employee and contractor investment. A really accurate metric to determine if you're on the right path to profitability. So that's my 5-pillar metric. A lot of metrics there, but that's what I implement, and teach for my students and clients.
Okay, a bunch of questions. We'll go through these different buckets now and just try to dissect them a bit more. But so on growth, right? Like you mentioned bookings. Is it bookings? Is it ARR? Do you try to normalize it for 12 months? Yeah. How do you do it?
Oh yeah, I just have that question in my private student Slack community. Someone, do I annualize that? If say I have a renewal, but it's a prorated term. And so if it's ARR, say they sign up and they, it's just a 6-month term, and then they want to do a 1-year term. Usually what we're going to do is I am going to annualize that as long as we have decent retention, because we don't want to overinflate our bookings number. But if we feel good, that to annualize that number, say it's a renewal, a prorated renewal, I'm going to take that ARR value, because it's important to push that ARR value into our go-to-market efficiency metrics. So I'm okay with that as long as retention is okay. That, if I, annualize that, but then they churn after 6 months, if a lot of that happens, then we have to reconsider.
Yeah. Okay. And do you look at year-on-year growth metrics by month, by quarter?
I like to look at growth metrics for bookings and, for bookings, usually on a 3-month period versus the 3-month period a year ago, or even better, the longer that time frame you measure, the less people could argue about your growth rate, right? Because it's easy to just say, hey, we had a great month this month versus a year ago. But the longer time period, the less people can argue with that growth rate you're presenting. So if you can do like a TTM, trailing 12 months over the prior 12 months and show a fantastic growth rate, man, that's great. But usually I do 3 months over a year ago, 3 months.
Yeah. Okay. Any benchmarks on growth? I mean, I know it's like there's a lot out there, right? Iconic releases some great reports on benchmarks on growth, but like, yeah, any views on that?
Yeah, Iconic produces some fantastic reports. And, you have to be careful with growth. I think it's in the eye of the beholder because it's very subjective. If you look at, say, an Iconic, these kind of best-in-class investment funds looking for elite growth, where they may want 200, 300, 400% growth. And you look at SaaStr and Jason Lemkin saying, if you're early stage, you need 200% growth starting out to be VC fundable. Now, the benchmarks, I work with, I partner with Ray Reich at benchmark.ai, and he produces private SaaS metrics benchmarks. And those, it's like a little bit more down to earth, where maybe it's, a median growth rate is 50%, top performance is 100%. So I think you just have to be careful. And I was just talking to a client the other day where, they're growing at a, huge rate, but then their board wants them to grow at 300 to 400%. So it is kind of all over the place.
Yeah. Obviously, in context of where you're at, right? So if you're below 1 million, 10 million, 25, 50, 100, 200, 250, 500, right? It's like all different growth rates. I think, if you want to learn more about like year-on-year AR growth metrics, there's like one Iconic report which looks at that. And for example, just as a metric, right? Like best in class for below 25 million is now up from 75% to 89%, which I think is interesting. But then also 25 to 100 million is actually down from 2021 90% to now 28%. And I think this is essentially the change, right? We've seen growth at all costs to efficient, predictable revenue growth. I think everybody's familiar with that by now. But obviously it changes the financial metrics significantly, and is probably in many cases not seen on the growth rate, but more on the efficiency metrics, right? You had 5 pillars. Now I'm like getting, now I need to remember what was the second pillar.
Second pillar is retention, right? So we land our customers, expand them. Now we've got to keep them.
Right. So NDR, net and gross dollar retention, like what's the definition there? What's the difference?
Yeah. So say gross revenue retention, that maxes at 100%. And then it subtracts churn and downgrades or contraction. So it's really focused on our existing customer base and what we're keeping from our existing customer base. And then NDR builds on top of that. So really it's GDR, plus now we can take credit for expansion. And of course, we want that number above 100%. So it doesn't factor in any new customers, just expansion on the NRR side.
Yeah. And I mean there, right, like I think that's basically, if you want to create like a really successful company, you want to see NDR probably above 110, 120%, right? So if you do nothing, you would still continue to grow revenue at a clips of like 10 to 20% year on year, right? That's kind of the metric, or?
Yeah, so right. And it depends on your price point. If you're selling a $50 price point product, the expectations are much different than $100,000. So generally you see best in class, higher price point, 120% NRR and above is great. And then it could be 110 for, as you move down ACV. But then if you're a B2C app or just say $10, $20 a month, much different. Maybe it's just, hey, let's just get to 100%. If we're just a little bit over 100%, that's really good.
Yeah. Great. Let's move to bucket 4. 3, sorry.
Margins. Yeah.
Margins. Yeah.
Yeah.
What's the most important thing to look at there?
So really, we've got to have an accurate gross profit. So revenue less COGS. And I do a ton of coaching sessions on just expense coding and COGS versus OPEX, because I see those being coded inaccurately all the time, because we can't, it's a big hurdle. If we have low gross profit, say we're a 10 million ARR company and we're running 55% gross profit, that's trouble. But if we're a million ARR, that makes sense, right? We're scaling, we're building out. The expectations are different based on ARR size, but eventually that gross profit has to climb into the 70s. Otherwise, it just holds back cash flow, EBITDA, and it's just hard to, we're just limited because everything's being eaten up by COGS.
Yeah, I think it's so interesting. I spent some time investing in companies, and I think as a startup, you always refer to revenue as ARR, so it's all recurring. Ideally, 5 years term minimum, but the reality is different, right? The reality is not everything is SaaS, right? So your gross profit in a marketplace has a very different margin profile often than in software, but software like 70% plus is your kind of. Do you think AI and kind of the cost of AI will change that? Will eat into COGS significantly? Are you already seeing that? Or?
Yeah, it's interesting. The AI that, and I was just at a SaaS conference and, there was a presentation on that where, they're thinking like, initially maybe the AI infrastructure, getting that going will have, you'll show early stage low COGS or low gross profit, but eventually that should scale appropriately. So it's a big consideration how AI intensive is your product, because I've seen other SaaS companies where it's like a very database, like it's a database product. So they'll never hit, say, 75% gross profit because there's so much compute power that they need. Mm-hmm. And same thing for AI. We've got to understand how much power are we going to use? And we have to understand are we ever going to get 70 to 80%? If not, why? Because we're going to need to explain that to our board investors and potential investors, just so they don't look at our P&L and say, well, what's wrong with this company? Well, this is what's going on. This is why we need this infrastructure.
Yeah. I think you said something which I think also resonates super well with me is if you have high growth, often gross profit margins don't matter as much initially. At some point they'll matter, right? So I think that's something to keep in mind. But then also I think being very aware of like what's realistic and where can you get to. I think as a revenue leader is super important. I want to talk about actually bucket 5, right? Because this is a RevOps podcast, so obviously go-to-market efficiency matters a lot. What are some of the key metrics you look at there, and how would you define them?
Yep, it all starts with CAC, so customer acquisition cost. Building that foundation correctly on your P&L. We have accurately coded sales and marketing expense, and then CAC payback, top investor operator metrics, so the months to pay back that upfront customer acquisition cost. And it's also gross margin adjusted, which is why we have to have the proper SaaS P&L setup. Then, of course, once we have CAC payback, calculating lifetime value, and then we can calculate LTV to CAC. And then there's cost of ARR. Sometimes that's called the SaaS CAC ratio. That's really the cost to acquire a net new dollar of ARR. Great metric, great benchmarks, easy to understand. And then you can also segment that between the cost of new ARR and the cost of expansion ARR. So those are the big ones that I implement or teach in my course. And then there's also magic number, and that just depends, on kind of price point, I think, for me in sales cycle. But those are the big ones for go-to-market efficiency.
Yeah. So LTV, like, how do you do it? I really struggle with it because, how do you know the LTV, and at what scale of company does this even make sense to talk about?
Yeah, it's a tricky one because I think if you're mid-market enterprise, you have a high price point, I'll calculate it, but I feel it's less applicable. I'm really going to look at cost of ARR and CAC payback. Because sometimes, if you get a 50 to 50x ratio or 40x, well, what does that really mean? Is it truly accurate? Because we know deal sizes. If I land $1 million customer versus 100,000, LTV to CAC could be so much different. So I think LTV to CAC really applicable if you have a low price point, so kind of self-serve, high volume model or PLG, really important because you're constantly refining your acquisition channels and the paid spend, for example. So really important to have a good LTV to CAC there. And then bigger companies, bigger ACV, calculate it, see what it's saying. So it just depends. And I think, again, with efficiency metrics, this is not, when you're $1 million ARR. It could be kick in like when you're 3 to 5 and enough volume of data flowing through your business where it makes those metrics valid. But usually, when I help companies in that 3 to 10, we're implementing those go-to-market metrics.
Yeah. And then do you split COG by channel or?
Yep. Then, so early stage, maybe you just have one channel, one product, but then as you're scaling, if you have multiple products or multiple channels, then you have to look at segmentation. And now here's the big holdback when people say, I want to calculate, say, payback by all these different channels and products. Well, on the revenue side, so, it's usually pretty easy to figure out where that revenue is coming from or what product line, but then we're held back on our expense structure. It's because typically in our sales and marketing expense, we're not coding to that level of detail. This channel versus this product. So you have to go through this big allocation exercise. So that's where you really have to work with your finance team, your CFO, if you want to start really refining those CAC segments and those metrics, is to then you need good coding accuracy.
Yeah. I mean, I think in RevOps, right, we all know top of funnel is very, very hard to attribute, right? So was it the course? Was it LinkedIn? Was it the paid ad? How many touch points do you need to actually acquire the customer, and where did it start and where did it end, right? So multi-touch attribution, the big topic, and marketing ops, really challenging topic. And here, I think the interesting difference is basically you look at investment by channel and get a better understanding of what is that. To get that to reality is just a really challenging exercise in my mind. I think one area where finance and RevOps can work really closely together, I feel.
Yeah, definitely. And it's, don't feel bad if you can segment to certain levels. I've talked to 100 million ARR companies who are just, just have one CAC payback period. So that's the importance of putting that finance and accounting foundation in place. So as your company scales, all your finance data and accounting data can keep up with the demands and what people need to run their departments.
Yeah. Okay. I don't want to leave this without asking, what's the magic number?
Oh, man. Yeah. Yeah. Magic number is taking quarter over quarter revenue change and then annualizing it by multiplying by 4. And then dividing by the previous quarter's sales and marketing expense. And they're lovers and haters of it, but if you think about that calc, it's a very short time period duration. So if you're going to use magic number, I'd say it's more applicable to short sales cycle businesses versus if you have a 12 to 24 month sales cycle, right? Quarter over quarter revenue growth attributed to the previous quarter sales and marketing spend, there's kind of a disconnect there. So I same thing, I calculate it, we benchmark it, but I think it's more applicable for shorter sales cycle. And with magic number, it's all your revenue. So you can't, if you have a bad magic number, you can't just go to RevOps and say, what's going on with our revenue growth, right? It factors in churn, all this stuff. So indirectly, we have influences from tech support, customer success, everyone who touches a customer. That's why kind of there's some haters of the metric, but I think, again, applicable to shorter sales cycles.
Yeah, I mean, I think in RevOps, so we had Jaco van der Kooi from Winning by Design on the show, right? And so we talked about kind of the different levels of metrics and the hierarchy. So from input metrics to basically the more abstract finance or like SaaS metrics that bundle a lot of stuff in, right? They're great to measure businesses on a holistic kind of, investor point of view and benchmark, but then they're really bad to actually take action, right? Because a lot of stuff is bundled into them. And I think, one other thing, another thought I want to share here is, in the end, I think what you're referring to is, right, like you have a bunch of different metrics to understand the health of, various different types of, the business. And I think it's very similar to forecasting, where you shouldn't rely on one thing, but like in finance, you usually do like a best case, mid case, low case, right, forecast. And you have different input factors for those. And different scenarios. And I think in sales forecasting is the same. It should be the same thing, right? You have your weighted, dynamic weighted, bottom up prediction, whether it's an ops model prediction or an AI prediction. Super important takeaway for me, to basically have the data right and then try to draw conclusions from those. But really start with the foundations, getting the data right? And I think this is something you're you're also alluding to throughout the whole episode here, actually.
Yeah, the data foundation is so important. We know we talk data, but it's so true. And there are 4 key SaaS finance data sources that I use and spin up when we create metrics. And that foundation helps us create a repeatable process, because we don't want to get in due diligence or talking to our board and we created all these metrics on a fire drill. That's kind of my worst nightmare as a CFO.
Yeah, absolutely. And I have 2 wildcard questions and 1 closing questions. So I want to know, in an ideal world, right? How do finance and RevOps work together?
Yeah. So as a CFO, SaaS CFO, where I spend most of my time is in sales and marketing, right? Because there's big investment there, and right, it's driving revenue growth. Everybody wants to know pipeline, close bookings. So that's where I'm spending my time, understanding where the funnel is. Does it support our AR target, or do we have a gap between the target we're after and what the pipeline says? So as a CFO, I need to understand that lead flow, the opportunity pipeline, what's important, what are those key conversion points, that ends up in that commit number that the CRO or CMO is giving to me. So I need to understand it. I'm not telling them what to do. Maybe I'll influence thinking based on what the numbers and metrics are saying, but I need to understand how that operates. And just like I think any good CFO, we have to understand how each department operates. But a lot of my time is definitely spent in sales and marketing and RevOps.
Yeah, it's actually funny you say that, because I think RevOps also spends a lot of time on exactly those topics. And I love this, notion of the go-to-market CFOs, right? So CFOs becoming a lot closer to go-to-market. I think in SaaS actually quite advanced, right? Because sales and marketing spend is often, 50, 60% of P&L. So you obviously want to spend your time there. Second question, what are the common things finance don't understand about RevOps and vice versa?
I think, one, with that question is sometimes RevOps, it could be a broad category. You hear FinOps and RevOps. So what does that mean to the company? Now, if you're internal, you probably understand. But is it sales operations? Is it truly someone who is managing kind of that lead funnel and overseeing campaigns and conversion points and taking ownership of that? So it's just trying to understand, what does RevOps mean to that company? Because then usually, because there are a lot of terms being, pushed around, but really it's, for me, it's what is our go-to-market motion? Is it PLG, SLG, community-led? So many LGs now, or, that it's because I need to understand how our go-to-market motion is segmented. So whether we call it RevOps or not, I just need to understand how our top of funnel to end up, closed won deal works.
Fantastic. Yeah, awesome. Look, here's my closing question. What's the kind of thing anyone has ever done for you to move your career forward?
I'd say, in any industry, it's a small world. Yeah, I love SaaS because it's global, but also so small. And I think in any position, for me, it's just feeling good about all the relationships that you're making, because it can pay off later. And I'd say one director level job that I got was because of a former boss who referred me to that recruiter. So it's, maintaining those healthy relationships, those networks, because you never know when it'll pay off down the road.
Yeah. And it's usually more fun that way, right?
Yeah, that's the best way.
100%. Look, thank you so much. I think this was a lot. We covered a lot in 40 minutes. If you didn't understand everything, which I would be surprised if everybody understands everything we just said, right? Go to the website, the SaaSCFO.com, subscribe to Ben's newsletter, really great resources to learn more about this topic. I think it's a really important topic for RevOps to understand the finance world, and also for finance to understand the go-to-market world, as we just discussed. And yeah, thank you so much for listening, and wish you all a great rest of your day.
Thank you very much for listening to this episode of the RevOps Lab Podcast. Please consider to like and subscribe our show and give us a 5-star rating on wherever you're listening. If you have feedback or suggestions, let us know at podcast@getreflow.com. We read and reply to every email. Thank you.